Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. You should be.
Posing.
Now, it's the Thursday, January 16th. Market call. 1 o'clock on the East Coast.
Okay.
Guy Adami, what are you okay? I mean, you like Elizabeth Young Thomas.
Active listening.
Today is a bit of a somber day.
It is.
Especially for the folks in the Midwest.
Yeah.
Now, we all face the same inevitability, and 90 is good run. But Bob Uecker passed away today.
He did.
One of the all-time, absolutely one of the funniest men I've ever listened to, seen. Hysterical.
I mean, baseball games are long.
Yes.
They've gotten shorter because of the rules. But back in the day, they were long. They were allowed to drag on as long as they could. And listening to Uecker call a baseball game made it that much more entertaining. There are phrases that will forever live in my head. There was a player, his name was Greg Vaughn.
Sure.
When I was little, he was center fielder. And Uecker's famous phrase of get up, get out of here, gone for Greg Vaughn is like, for some reason, the rhyme of that, when I was 10, or whatever it was, that was the best thing ever. And he was such a legend. He will remain a legend 100%. Forever. And we
beloved. Beloved,
dearly.
Obviously in Milwaukee, beloved throughout the baseball community, but he transcended that. He was on Johnny Carson's show over 100 times.
Oh, wow.
And you should go to the YouTube. I mean, hysterical.
Yeah.
I mean, just the man was an effing genius. If Bill Hockman was 1/10 as funny as Bob Uecker, he wouldn't be sitting there with a Yankee cap right now.
Well, and Brewer fans will remember all the commercials that Uecker had to do. He would have to talk about using or sausage during every game. All the brands that sponsored the Brewers and just all the taglines he had to read. There's no replacement. And it's big shoes to fill.
Yeah.
Brewer fans across the land are sad today. But we were glad to have him as long as we did. He started announcing for the Brewers, I think, in the 70s, long before I was born.
It's been an incredible run.
Yes, incredible. I think it's the longest. It's a record. It's a record for an announcer.
And a lot of people know him from Major League, and we're going to talk about the markets in a second. But they told him he was, I think, like Harry. I forget his last name in Major League. He was the announcer for the team. They said, "We're not giving you lines. Just ad lib the whole thing."
Do you. Yeah.
And it was brilliant.
Yeah.
So rest in peace, Bob Uecker. Anyway,
yes,
we are here to talk about the market. And, it seems to be a pretty benign day as we're sitting here. The S&P is basically unchanged. And NASDAQ's a little bit lower. We'll talk about those things. And obviously, Elizabeth has a note out. And this is, I think, timely given what we've seen over the last couple days in terms of PPI and then CPI. I think PPI scared some people. Obviously, CPI assuaged some of those concerns. But as we get into it, what we typically like to do is look at the S&P. So throw that up, Jacob, real quick, and you'll see, we have that little gap higher. I still think, we're in that downtrend line from, if you were to go back to sort of middle of December or so. So that downtrend is still in place. I don't think we're going to take it out. But again, what I said to Dan yesterday was, in August, we traded down the 150-day moving average and bounced. In September, we didn't get there, but a similar type of move. And obviously, we saw this move almost down to the 150-day last week. I think it was Friday that the market cascaded lower. So if you were to look at this and say, this is just more of the same pattern recognition, and there's no reason to be bearish, and this is just lower left, upper right with some disruptions along the way, Elizabeth.
Yeah, I mean, little bumps and bruises here and there. I think a lot of it is that just the psychology of investors right now. We're not used to pullbacks, right? We're not accustomed to it. So 5% feels like a lot. It's really not a lot in the grand scheme of things. And frankly, an opportunity because the market ripped after the election, and anybody who wanted to get into certain stocks at that point feels like they missed it. So now this is a little bit of an opportunity. And look, the other thing to focus on, it's a benign day broadly, right? We don't have any runaway returns in broad indices, but there are some stocks that are doing pretty well today. So, and there are some that are also getting hammered, right? So I think this is probably the story of the market, at least for the first quarter, maybe the first half, where you've got a lot of bifurcation between winners and losers. And it is an environment where stock picking hopefully prevails, which means that fundamentals have to be the driver. Maybe technicals aren't the big driver anymore. Maybe macro isn't we'll
Mm-hmm.
see, isn't going to be the huge driver anymore. And you have to pay attention to things like earnings.
Well, it's
We'll talk
interesting. I
about
mean,
that.
yeah, you're right about the macro, but what's fascinating to me is at least through my lens, macro really, because for me, if macro in fact was a driver, just in looking across the panoply of things I look at, we should be lower. So other people say, you know what, you're just sort of cherry picking. You want to be bearish. No, I mean, there's some things that are out there on a macro level that are concerning. And you mentioned, picking stocks. Today's a great example of exactly that. So Jacob, throw up a Taiwan semi chart, because obviously that's having a day today. I think it's up over 5%, which is not insignificant for a company with a market cap probably approaching $1 trillion. We're trading towards the levels we probably saw in the beginning of the month. We obviously had to move lower. Now here we are again. This looks pretty good. I mentioned Taiwan Semi, though. Obviously, I think, as I've said on Fast Money dozens of times, one of the 5 most important companies in the world. Now throw up an NVIDIA chart, because one would have thought, again, if you had told me the Taiwan Semi is going to be up 5%, you could say, well, it's probably going to drag up NVIDIA as well, given the sell-off we've seen since their earnings release. Actually, as we're sitting here, NVIDIA is actually down 0.75%. So that sort of works nicely with your, ability. You have to be picking stocks at these levels, and some are winning and some are losing. And as you throw up a NASDAQ chart, real quick, Jacob, I'll say that, for whatever reason, and all of a sudden it's been now for the last couple weeks, Apple, and I don't want to say it's fallen on hard times. That's not my point at all. But, a stock that traded up to 260 and change, I think on December 24th or something, or excuse me, maybe the 26th, the day after Christmas, is now 230. So you can start to do that math and say, hey, wait a second, this is actually a bit of a move here. And as we're looking at Apple, once again, we're at that 150-day moving average, which we last saw back in August 5th to be exact. So this is a pretty critical level. So pull back the NASDAQ chart real quick. You have these basically dueling forces right now. You have some semis doing well, to your point. You have some of these bigger cap names that are sort of giving it up a little bit. And as I look at this, Jacob, and this is a static chart, but if you want to draw a downtrend similarly from that December high, I mean, this downtrend for a very short period of time is intact. So that's the way I sort of look at this right now, Elizabeth.
So you know what's interesting about what's happening today? If you look at the sector makeup of how things are trading, we've got the only sectors in the red right now intraday in the S&P: communications, technology, and consumer discretionary. The reason that's interesting is because we have a 10-year yield that's down. We have a 10-year that opened the day somewhere in the 468 range. Now we're down to 460. It fell mostly on comments by Fed Governor Waller. He said something along the lines of, if inflation surprises to the downside, or if the data cooperates, rate cuts could actually happen in the next few months, which then cause the market to pull forward, or the expectation that a cut in March is actually more likely, not baked in, but more likely. And yields fell on that news. Now, I talk about relationship problems all the time. This is one of those odd relationship problems.
Do you think you and I have a relationship problem? No. Not at all, right?
No,
we have a very solid relationship.
I think we do have a
solid
relationship.
What do you think?
Sorry.
Anyway, continue, please.
I talk about relationship problems all the time. This is one of those problems.
Right.
Now, last Monday, we had the opposite problem. We had yields up and growth stocks were up. And I said, that can't last. It just doesn't persist. This is an interesting day because we've got yields down and growth stocks down. So if you look at just the market action of that and ask yourself, why would that be happening? I don't know the answer to that today, but it's something that is maybe a tiny bit concerning. You don't want to see a sell-off in growth stocks on a day that should actually be supported by yields falling and the idea of maybe the Fed bringing cuts back into the picture sooner rather than later. So this is something to watch. The other thing I'll say is if you look at ETF action, so just the way some of this stuff is trading, the Qs are flattish today, right? But if you look at just stocks that we talk about a lot of these big names, so you mentioned Taiwan Semi, we've got Palo Alto, Broadcom, Supermicro, Dell. I mean, a bunch of these names, at least on my watch list, NVIDIA, Apple, most of them are positive, but it's the big ones that are pulling it down.
It's interesting. So again, pull that chart up real quick, Jacob. And if you can draw a horizontal line across the top on the yields chart that you just had up. And you can see where we just topped out at is sort of the levels that we saw back in the spring. So, that's that. If you want to quickly just go to a TLT chart, and I'm sorry to make you jump around, Jacob, but you'll see the opposite, obviously, in terms of TLT. And this downdraft took us down to, and if you go longer term, you'll see, I thought we were going to get down to about 82 or so. By the way, I still think we're going there, but for whatever reason, we seem to have stopped. Now, maybe it's just bouncing off an oversold condition, and we're going to go to your note in a second because I think it's important. But, PPI was what it was. I think CPI, the market, a collective sigh of relief. But, I look at some of those numbers and say, you know what? I don't know. I mean, inflation is still a problem. And I don't even know if it's inflation that's sort of the driving force behind yields anymore. But you're right to point out those comments from Waller. That gave the market, I think, a bit of a relief as well. And here we are. So maybe we get this bounce in the TLT. Maybe yields trade back down to 455 or so in the 10-year. But I remain convinced that at some point over the next month and a half or 2 months, we're going to take a visit at 5%.
Yeah. Okay. So let's go over a little bit what happened so far this week. PPI came out on Tuesday. CPI came out on Wednesday. The reason that Guy is saying PPI made people a little bit nervous. First of all, we have to understand about PPI is that it represents things from basically the wholesale perspective. So what are the prices that businesses are receiving? I think you can take this data one of two ways. And that's why I think there was a little bit of jumpiness in the market. So PPI actually came in cool for December, and it came in cool month over month. It came in cool year over year. And you might be saying, well, isn't that a good thing? We want inflation to come in cooler than we expected. This is a year over year view, which in fact shows a rising trend recently. But don't we want it to come in cooler than expected? Yes, we do, in the sense that we don't want more pricing pressure, but it can also be an indication that there's cooler demand. And PPI is usually a leading indicator of things like PCE. So then you ask again, don't we want it to come in cooler? Yes, but you don't want the corporate sector to be reporting cooler demand. You don't want them to be reporting that they're not building up inventories anymore. The positive way to look at this is that if it's input costs that are causing PPI to come down, then you've got companies saying, okay, our input costs came down. We can make stuff cheaper, right? We can make the widgets cheaper, but we can still sell them at roughly the same price if CPI doesn't come down, which then means margins expand. So there's a delicate dance here that needs to happen between PPI and CPI. And I think what the market is interpreting this as, because CPI came in pretty much at expectations, what the market is interpreting this as right now is that, okay, CPI came in at expectations. There's no reason to worry that inflation is overheating right now. Maybe margins can stay intact. This is still positive for economic activity. And I think today, given this data, that's probably the right take.
Yeah, and that's a very tenuous relationship between the two, that right now the market is saying, you know what, that's where we want this to be. Now, sometimes the stars line up. You know this.
Sometimes.
And sometimes, like, you'll do something and in retrospect, you're like, well, that was genius that I did it. And the title of your note, Liz looks at first inflation data of 2025, priceless. And as we started with Bob Uecker, he absolutely was. You could not put a price tag on the genius of that man. So there was some kismet going on here without question. But since we started to talk about all this stuff, let's go right to your note.
Yeah. And so I only want to highlight actually one chart in this part of the program. So if we pull up inflation prints in the S&P 500, that's what I want to talk about. So
pretty colors,
because I just went through, these are SoFi colors, SoFi branded colors. I just went through what happened with PPI and CPI. We don't need to beat that dead horse, but this is an important one to look at. So hang with me here while I explain what this is showing us. Basically, I've talked about this a little bit for the last couple of weeks. There's a seasonal effect that typically happens in the beginning of the year. You see inflation prints surprise to the upside. Now, remember, we got this data this week, but that was December's data. So what we should be watching is the first data that we get for 2025, which we won't get until February. Okay, that'll be January's data. This is what happened last year. So if you look at these, this is year over year CPI in the bar charts. This is when CPI was still reporting above 3%. Okay, so different times now. But what you see here is that all of those bars, January, February, March, and April, are red. They're red because they came in above expectations. Okay. Look at the solid line that we've overlaid with the S&P 500.
You call that purple?
I'm going to go navy blue.
Okay.
Yep. So the solid line is the S&P. Things are climbing throughout the beginning of the year. Okay, CPI is surprising to the upside, but we're convinced that the economy is fine, the job market is fine, so this is okay. And then we get to April and the market starts to hate it and decides, all right, now we've unpriced all of these Fed cuts. We've realized that the Fed is going to have to be more hawkish than we expected. And the market corrected pretty hard in spring on the heels of these CPI surprises. Now, that's not to say that it's going to happen the same way this time. We highlight this because if we do see some upside surprises, because remember, it's all about expectations. If we do see some upside surprises, you could see more volatility in the market due to that come spring. The good news, I think the supportive thing that we have going for us this year is that we're not expecting a lot of Fed cuts. Nobody's out there saying, I think we were saying 6 or 7 cuts at the beginning of last year. This year, we're saying 1 to 2 if we're lucky. So we don't have as much, I think, downside in the Fed rate expectations camp, but this is something to keep in mind.
You know, the wild card in all of this is this incoming administration and whatever pressure, if any, they put on Jerome Powell and the Federal Reserve at large for lower interest rates, because, you know, we know, and again, this is not political, but incoming President Trump has made a point of saying how he favors low interest rates for a myriad of different reasons, which, again, he's entitled to have his opinion. I think the problem here is, in my opinion, you know, that could be, you know, it was one thing in 2018 when the market, obviously from Halloween to Christmas, went down about 20%. And he sort of browbeat Jerome Powell, as did the market, into lowering rates as we got into 2019. But it's entirely different now, given where we are and given, I would say, the tenuous, relationship that the market has to yields. And it's going to be fascinating to see. And I don't think necessarily Jerome Powell's going to succumb, but there's going to be a lot of jawboning around that. The other thing, and we've talked about this as well, I would have looked at this and said, you know, we should have seen more significant sell-offs. And I thought of that all of last year. But what I've come to realize, and, you know, you try to learn from your mistakes, the amount of money that flowed into the market last year, you know, north of $1 trillion into ETFs and money. I mean, that just, to me, that just speaks volumes as to the power of passive investing and how, as much as this matters, your work absolutely matters. What I think that it's done is it's just pushed everything out. So things don't matter at the same timeline as they did historically. It's not to suggest that they're not going to, but it's just everything just sort of gets pushed out vis-a-vis these money flows. So I think that's one explanation here, at least for me.
Yeah, and you hear a lot of people say, especially stock pickers, say the macro doesn't matter. People are focusing too much on the macro. It doesn't drive markets. Well, it does drive markets in the short term. We saw that yesterday, a huge reaction to the CPI print. And if we get downside surprises, that does drive markets and volatility in the short term. But I agree that it's difficult to put an entire investing philosophy on macro data. All of it's backward looking. It's difficult to react to it in real time. That's why the Fed's job is hard, because they're reacting to all this backward looking data, mostly on a monthly basis. So what I think you have to look at macro as is you should still be choosing stocks, choosing investments, whether it's ETFs or stocks or bonds or whatever you're investing in, based on the fundamentals. But you can't do it with your head buried in the sand. And if your head is buried in the sand, it means you're not paying attention to the macro at all. So you do have to pay attention to it. Things like retail sales that came in today. But if you just look at one of the other charts that we highlighted today, the S&P 500 index level versus bottoms up price target.
Okay, hold on a second. I was going to set this up for you.
Oh, sorry.
No.
Please,
it's okay.
Be my guest.
We can pretend it didn't happen.
I'll take a sip.
Are you familiar with, do you fish at all ever? Are you a fisher person?
I used to. When I was little, I loved fishing, actually.
But like in lakes and stuff.
Yeah, in lakes.
Yeah, ponds, lakes.
Well, I have a friend who has a fishing boat. So I've done it off the coast of New Jersey.
Oh, really?
Yes. I caught a very large fish.
So you're familiar with this?
Yes.
Because if you fish on the East Coast, if you want to go big game fishing, like you want to catch large tuna or swordfish.
Okay.
See the way I said that?
I didn't catch either of those, but yeah.
Sword, because there's a W. Yeah.
That's right. I think it's
silent. You do it, it's called a canyon trip. So you leave at like midnight and you take your boat out to the canyon. Like, okay, I'm begging you. I'm begging you to explain what this means. Because what happens is, as you go out a few hours, it's actually more than a few, you get to a point where everything drops, right? The canyon is literally a canyon where the sea level goes from a few hundred feet down to thousands of feet. Put up your next thing because this resembles exactly that. What you're looking at in the blue, in the dark blue, that is the shoreline. And then as you go farther out, that's where things start to cascade lower.
See what you did
That's
there.
your canyon.
Okay.
See what I did there?
I do.
You can Google that
you
later.
You will never find me on a fishing boat at midnight heading out, getting started.
You go out.
I mean, you won't find me finishing at midnight either.
Those are canyon trips.
Yeah. I'm
if
not
you
take
Google, like you live out east.
Yeah.
I'm sure that you've seen, like, if you go to the Montauk, what do they call those things? Not the regatta. Help me.
A yacht
where
club?
the clubs. There'll be big signs like, sign up for a canyon trip. Now you know what that means.
Yeah, I'm not going to put my name on that list.
As opposed to Canyon Ranch, which is probably a place that you have visited because you're sort of highfalutin.
I have not been.
Anyway, apologies to you
so
and apologies to our audience for indulging me.
To the fundamentals. This is fundamentals. Now, we talk a lot about strategist price targets. That's top-down stuff, okay? Not that that's not fundamental, but it's top-down. This is bottoms-up, meaning every stock in the S&P, price targets that analysts have on every stock in the S&P, this is the fundamental stuff. So that solid line on the bottom is the S&P 500, where it's trading roughly right now. The dotted line on the top is an aggregation of all of those bottoms-up price targets. What this suggests right now is actually that the S&P has about 12.5% upside if those price targets are correct. So this is part of why you'll hear people say, well, the valuations don't really matter, or they're okay here because earnings are going to stay strong. And they may stay strong if we can now transition into the next table that I brought, which looks like a bunch of stuff going on here, but all we really have to focus on are the boxes that we highlighted. So this valuation level, and let's talk about this for a second, right? We're at 21.9 times.
Historically expensive.
Historically expensive on the S&P. Okay, so see that box highlighted there? We rounded up to 22, and that's with forward 12-month EPS at about $270 a share, okay?
Which is I think that's consensus-ish, is that right?
Consensus-ish, yeah, and that's right. That's right about where we are today. We're at 59.50 as I say this, so that's highlighting 59.40, okay? If you look at what EPS is expected to be 12 months from now. So let's say we're at the end of this year and we're looking at EPS in 2026. It's actually, I think, $306 a share. So somewhere in that range, even if we keep valuations constant, and we had a debate about this on halftime yesterday. Aren't these valuations too high? Even if we keep them constant, they don't have to go up anymore. That still suggests 11 to 14% upside in the S&P, which is right in line with a bottoms-up price target, right? So the question of, is this too high? Where do we squeeze growth out of? Well, earnings, to your point earlier, earnings matter. Earnings have to come through at the levels that we're expecting, and 2026 levels also have to stay where they are. And then you can eke out 11, 12, 13% in return, which pales in comparison to 23% of last year, 24% of the year before. But I'll still take 11 to 12% with all this other stuff going on.
Fair enough. 100%. Now, I don't want Mario and you did this.
Correct.
I love Mario.
Mario makes these charts.
Mario, by the way,
mistake.
He
I don't
emails
make
me from time to time, which I love.
Yes, he
appreciates I'd love to meet Mario. I've never met him.
Okay. Well, I'll bring him in.
You should one of these days. Maybe he could sit in on. I'm sure he has the ability to chat as well.
He does have the ability to.
So we should get him on this show.
All the time.
So go back to the prior, and I don't know, and I'm not looking to tee you up, but this suggests what we've seen historically. Now, my instincts suggest that if we were to go back 20 years from where we started, you would see a similar relationship. In other words, analyst price targets are always in excess of, right? So you wonder, what's the reconciliation there? And then, okay, so that's fine. And then you go back to this next slide that you're just speaking to. Here's where the rubber hits the road. And I would submit, again, if you think rates are going higher, which I do, I think you sort of may-ish on the margins. It's very hard to justify these multiples unless rates are going higher because the economy is thriving, which I'm not convinced of. So that's why, again, there's so many data points you take in and try to figure these things out. And then you look at the market, and the market's the ultimate judge and jury. So the market is obviously speaking right now, saying that everything is fine. It's an economic thing. I'm still not convinced of that. And quite frankly, I've been wrong not to be convinced of it for a while.
Well, here's what I would say. I think some conditions are necessary, and I'm going to absolutely agree with you on the rates thing. In order for this to happen, in order for 6,600 to 6,820 on the S&P to materialize and for earnings to stay this way, earnings actually probably have to beat expectations, and or the 10-year needs to get back down below 4.5, because at 4.5 is where stocks started to get worried that, well, wait a minute, now it's above 4.5. They're rising for the wrong reasons. We're worried about inflation, which is why we saw such a big rally yesterday on the heels of CPI. So if the 10-year gets back down below 4.5, we start to price in maybe 2 cuts for sure. Let's say 2 to 3 cuts this year, something like that. The data starts to cooperate from a macro perspective, as Waller said today. And then you've got EPS that comes in line, then I think this can happen. And we've got another year of, yes, elevated, perhaps slightly irrational valuations, but it persists, right? And to your point earlier, maybe it is just pushing everything further down the road, but there are conditions that have to happen in order for this to occur. If rates continue to rise, if we get near that 5% level, I think we retest somewhere around the 200-day moving average, honestly, on the S&P 500, which is, I don't know exactly.
No, we got close to recently.
Like
this little move recently probably got within, I don't know, 100 or so, maybe a little less than that. But we saw it in August. We saw it to a certain point in September, and now we're seeing it. We traded in August. We traded down right to the 150 and bounced. September, and this one we did not. But point well taken. Now, Jacob, there you go. I'm going to ask you to do something, Jacob. So Ted Williams, arguably the greatest in that, Ted Williams, George Brett, Tony Gwynn. I'll even throw a Paul Molitor your way. Some of the great.
Now I know what you're talking about.
Yeah. Some of the greatest hitters in the history of professional Major League Baseball. Each one of them has what they call the zones that if you throw a pitch in that zone, they're going to rake it. And if you throw a pitch in a different zone, that's sort of their cool zone.
Right.
So, Jacob, what I'd like you to do now is go to the Google and get that graphic up. And then we're going to do a little side-by-side to your latest thing. Whilst he efforts that, I'm going to take a question from Eric Lancelotti.
Okay.
Throw this up, Timmy. This is from Eric, so I can read on the screen. Or you can leave me hanging here for, there you go. Guy, XLU seems to be breaking out. Can this be sustained if the longer end of the curve continues to go higher? Great question. I do think what you're seeing today, obviously, today and yesterday, is a knee-jerk reaction to rates going lower. Now, what I've said for a while is, and I said this last year on Fast Money, I probably said it on this show, XLU was not only getting a boost from, at the time, lower rates, but also this whole AI thing. Like all of a sudden, utilities were sort of in vogue given the amount of energy that a lot of these companies are using. So it's like sort of a double whammy for them. I am not convinced, however, that that's going to continue. So I do think, these will get rich at some point. And if you're of the belief, as I am, that rates are going to continue going higher over the next couple of weeks, it's a tough own, I believe, in the XLU, especially if NVIDIA starts to give it up, which brings us to the call of the day. I mean, I am so effing good.
Smooth. Very smooth.
No, seriously.
Yeah.
Wasn't that smooth?
Nicely done.
Okay, don't effing patronize me. D.A. Davidson, do you know D.A. Davidson? Played for the Cubs. Reiterates NVIDIA as neutral. With this analysis in mind, we continue to believe 2025 could be peak year for NVIDIA, remains street low on 2026. 61 buys, 5 holds, 0 sells. Lowest price target is 130. I mean, it's not like we're all that far away from there now. So it's interesting. First of all, this is obviously a non-consensus call. I think we both agree. And something that I've thought incorrectly, although it's starting to sort of play out a little bit, is competition is clearly coming. Again, price to earnings, not a problem with NVIDIA at all. It's a price to sales thing. And the problem, of course, is if margins start to deteriorate, and not necessarily even in a meaningful way, if they go from 76 down to sort of 71 or so, people are going to pick up on that and say, oh, well, wait a second. We're on the other side of this growth and margins trajectory. Sell first, ask questions later. So I sort of dig this call, and I'm not asking you to necessarily opine on NVIDIA. That's not what you do. But again, the importance of NVIDIA in terms of the NASDAQ and the broader market cannot be understated.
Well, in terms of utilities, which is what you were talking about
Yes.
before, right? So in 2024, there was a point in late November, utilities were up over 30% on the year. And for a mostly defensive sector, utilities or something like consumer staples, 30% up is a lot. And you have to believe that there was a lot more going on there than people just being defensive. I don't think there was a lot of defensive positioning going on at that point. So utilities were driven last year by this AI expectation. We were going to have to build data centers. There was all this demand for utilities. That's also why copper went up earlier in the year in 2024. And then you get towards the second half of the year, and we know that investors got more discerning about, okay,
Such a great word, discerning.
All of this spend on
Were
AI.
you discerning in high school when, because you dated the high school quarterback?
I did not.
Yeah, you did.
No, I'm actually having trouble remembering who that was.
No, you're such a liar. Anyway,
no, I really don't.
Please continue.
I'm not sure.
I didn't mean to throw you off your train of thought. You do remember. Don't even.
I don't.
Because he's watching right now.
Yeah, he's definitely not. But I think it was somebody younger. I think it was a younger grade.
That's that's cougarish.
But I don't. Oh God. Anyway, back to utilities,
please.
So you see things like utilities performing really well. And last year I was pretty bullish on utilities. I am not this year. I don't own them anymore. I owned the ETF. I don't own it anymore. It is, of course, tough to watch a day like this, when you've sold utilities, but still, I think that this is a rate move. And I do think that you would need AI to produce a lot of returns again to drive utilities to that level of return. Okay. And then you have to compare it to something like consumer staples. If we're looking at just defensive sectors, staples has been terrible. It has just, the technicals on staples, and actually there's a tweet that I put out about this. I think it was yesterday. If we can pull up that chart too, the technicals on staples, if we're just comparing, optimism in defensive names, staples is not going well. So I don't think utilities are trading.
Hold on a second. That was lightning freaking fast. How the Jacob
we sent it earlier.
Oh.
We did a little.
Can I retract?
Yeah, you can.
Sorry.
So this is the staples chart. So it's, first of all, it's not that, okay, people are suddenly piling into defensives. If they were piling into defensives, they'd be piling into staples. Those green X's on this chart mean that it's an oversold territory, and it just continues to get more and more oversold. So what's driving utilities today, I agree, is a rates move. It's not AI. It's not because people want defense. It's rates, and rates are going to remain volatile. And I do think that all it takes is one little data print in the macro to shove that 10-year back up towards 480, get it even closer to 490. And if some of that seasonality comes true, where we surprise to the upside early in the year, you're going to see the 10-year up close to 5.
Yeah, a couple lousy auctions away, I think right back where we were. And in terms of this staples, and I think you would agree with this, there are two things going on here. They were no longer, when I say the group was no longer able to pass the cost on to the consumer. So their margins contracted, which the market picked up on, and the dollar strengthened, which didn't help this either. So this was sort of the double whammy. Real quick, Gary Webb says Bessent said in Senate hearing that he's going to prioritize Main Street over Wall Street, as he should, by the way. I don't know necessarily what that means, but I'll also say this, not that Treasury is that big of a contributing factor, but the wealth gap in this country, for a myriad of different reasons, continues to sort of widen out. Now, I have said I think it's disproportionately because of Fed policy. I'm not suggesting I'm right. That's just my view. But the fact that he makes comments like that, I think, is encouraging. We'll see how it plays out. Now, with that said, pull up your chart with those reds and greens and blues with all the little boxes. Can Jacob do that?
The matrix.
Is that what we call that?
This
the
one?
matrix.
Yeah.
Okay. Visualize that. You see it?
Yeah.
Ted Williams, the splendid splinter, played for the Boston Red Sox.
Oh.
See what I did there? You see what I did there? You didn't think that existed, right?
That's pretty cool.
So in that box, it shows you what his batting average is for each pitch in that zone. I mean, this friggin' guy was locked in.
Wow.
Right? Yeah. Wow. It's pretty impressive, right?
Yeah.
You see how my mind works? Okay, you're not at all
I
interested in
can't
this.
read the numbers. No,
Well,
I'm
it's
trying to
very
figure
hard
out.
to read. I don't know if Jacob can make that. But
So,
in each box, there is a number. That number is the batting average. Here it is. Look at that.
okay.
Look at that. See?
Oh, got it.
I mean, the
Okay.
guy's hitting
So I was
freaking
gonna say, I was trying
400.
to figure
You
out.
groove a fastball to this son of a bitch,
Yeah.
and you
good
might
luck.
as well just put him on first base.
Yeah. Maybe even further than first base.
Well,
What
maybe
was
even
the slugging?
further.
What was the
Was
slugging
it further or
percentage?
farther? Because farther is a distance.
Farther, I
We're furthering this conversation.
farther.
But you see how my mind works when I saw that thing?
Yeah.
You're starting to understand sort of the psychoses?
Uh-huh.
Because I'm really not all
I don't know
together
what
with it.
Molitor's looked like.
I'm
Ryan
sure-
Braun's, I remember, was
Can I tell you
he
something?
had like the longest bat ever.
Really?
So it was.
What about in baseball?
Well,
Did that help him? Did that help him?
Oh, for God's sake.
Bill,
So
did you hear that?
his hot spot was
I'm sure he had a hot
blowing
spot.
away.
Well, if he had a long bat, it would be
Oh,
long and away.
Good Lord.
You said it, not me.
I did. I walked
You just
right
walked
into that
right
one.
into that.
Next question.
Well, here it is. We did have a question. Oh, here it is. Question for LYT.
Okay.
That's you.
I'm ready. Is it about Paul Molitor?
No,
He was
this
number
from
4.
JS. I thought I had read that as an older. I thought I had read that. I thought I had read that as the older high. Okay, thank you. That as the older high inflation data falls off, the year-over-year CPI readings for the first quarter 2025 were likely to float down. Is this really a surprising decline? I'm trying to sort of ascertain all this.
So first of all, this latest report was for December. So not necessarily the decline. And CPI was pretty much bang on expectations. And depending on which estimate you look at, I think it was the Dow estimate that actually we surprised to the upside month over month on CPI. So the chart that I showed before, those were times when we were reporting CPI above 3%. Now and core, we're still above 3%, but headline is below 3%. If we compare, so this is what we call base effects, right?
I love that.
So when we look at year over year compared to 2024, because those were surprising to the upside, you could see actually a positive effect from base effects. And what I mean by that is if things are sort of staying steady, because the beginning part of last year was hot, you might see year over year come in cooler. That's a possibility. But I remain concerned about the fact that it's about expectations, not necessarily about the actual numbers. So if the expectations are too low and we come in above expectations, regardless of whether or not the absolute number is still looking okay, it's the above expectations that is going to scare the market. So that's what you want to really watch. But you are right to point out there could be some base effects as we've got these hotter data that we're comparing year over year.
JSJ uses a $sign for the S in his name, like
Clever.
Kesha used to do.
Clever.
You impressed
She
that
doesn't do that anymore?
Apparently not.
Oh.
Is she
that like
still a thing?
50 Cent doesn't wear a Band-Aid anymore? Or is that
She is
Nelly?
still. Bill is
that
nodding
Nelly?
his head.
Is that Nelly that wore a Band-Aid or
Why
Nelly?
wear
Nelly
a
wore
Band-Aid?
I have no idea.
You know, Amanda's not feeling well.
Okay.
She's sick.
That's too bad.
It is too bad. But Jacob is doing yeoman's work, and he would be upset at me if we didn't do this slide being the chart of the day, because he put it together. Slide it, Earl. This is Intel, chart of the day. Now you're saying, what the hell is that? Well, let's go to the next slide, Earl, and take a look. Downtrend in place. However, we have now traded down to levels that we saw back in August, September, a number of times, seemingly holding. If one were to get a bounce to the downtrend line and break, theoretically, we should be able to trade up to about 24 or so, which is the 150-day moving average. So you say, well, big effing deal. Well, actually, it is a big effing deal because it'd probably be about a 20% move-ish back of the envelope math.
Okay. Is this a company you want to buy?
No.
Okay.
I don't think they're fixed at all. But I think, if you're looking to play the trading game,
yes,
this could be an interesting trade. Now, I'll also say this. Pat Gelsinger, he was the CEO that's now leaving the company. You know this name. He did like some sort of conference call, was on stage, and he did a single push-up on stage.
Like a single armed push-up or just one push-up?
No, one push-up.
Well, how was this formed? I mean,
one push-up.
One good push-up maybe counts for 5 bad ones?
Honestly?
I don't know.
Well, that night
trying
on
to give the guy
CNBC's Fast
a
Money,
little
we led
help.
with Intel.
Okay.
And I said, that was a Johnson move. I said he should be thrown out just because of that. And guess what happened a few months later?
Oh,
Yeah.
you think that's what
So
they put in the note?
100%.
They were like that.
No,
push-up.
because if
we
you're going
weren't
to
sure
do
about, we were
yesterday,
on the fence,
by the
but
way,
that push-up. Oof.
Bill was all excited yesterday because I went on one of my diatribes.
Uh-huh.
And I'm going to go on a mini diatribe now,
Okay.
if I may. If you want to be all macho wacho, okay? Do you remember that whole macho wacho, Bill? And when like, don't do one push-up. Be like Jack Palance when he was at the Academy Awards. Some 80-year-old man, after he just was in City Slickers, his ass got down and rattled off like 10 friggin' push-ups. I mean, okay, in his tuxedo, I'll give him some kudos.
Okay.
But don't be getting up there on stage in front of your minions and do one push-up and get all badass on you, because that's just a Johnson move. And that speaks to a character flaw. When I was at Drexel Burnham, so I started in 1986.
Okay.
Drexel was what?
I was 4
years old.
Yeah.
Okay. I wasn't. I was in my early 20s. And Drexel had we had a big event. It was either at the New York Public Library or the Metropolitan Museum of Art. I don't remember where, but it's not really that important for the points of my story. Okay. Everybody from Drexel was there. Everybody from California. Michael Milken was there. At one point in the evening, I went to go to the men's room. I had to take a leak.
Okay.
So I go to the men's room, taking a leak. And if you've ever been in a men's bathroom, they're urinals.
Only by accident.
Huh?
Only by accident.
How did you make an accident?
You like you don't see the sign. You walk in. You're like, oh my God, wrong door.
You did that?
Pretty much.
So they're urinals next to each other. So I'm taking a leak, and some guy stands next to me. Not because I was anybody special. He needed a place to take a leak. And I look over at him. I wasn't checking him out. Okay, let's just be clear. Sure. But I looked over at him, and he was literally half my size, height-wise, not Ryan Braun-wise.
Where is this going?
Okay, so I said, oh, that's interesting. I walked out of the bathroom. My friend Nadav said, and that is the name, Nadav, Nadav. He said, do you know who you were taking a leak next to? I said, I have no effing idea. And he said, that's Fred Joseph. Now, Fred Joseph ran Drexel Burnham. I turned to Nadav and said, we're screwed. I didn't use the word screwed. I used another word that began with F. 3 months later, Drexel goes bankrupt. My point is, I have a great track record with this stuff. Okay? So if you're a short man, don't run a company, number one. And if you're going to do push-ups, do more than one, number two.
I'm going to have no comment on
any of those things.
But thank you for sharing.
No, it's just share. That's fair.
You don't remember if it was at the library or
I don't remember if it was the New York.
Were Patience and Fortitude there?
Pardon me?
Do you know who they are? It's the name of the lions outside the library.
Yeah, no. Oh, so those are the lions' names?
I think that's what their names
are. No, but I'm being honest with you. I don't remember where it was. That's a long time ago.
Okay.
Lots transpired since then. Yeah. Okay, you want to get out of here so badly.
Well, no, I don't necessarily want to get out of here. I want to stop talking about the men's bathroom. But so Intel, back to Intel.
Oh, we're back to Intel.
One of my favorite books of all time is called
Hockey Stars of 74.
Only the Paranoid Survive.
You know what? 100% true.
And
well, that's, what does that mean, though, survive? Does that mean thrive?
Yes.
Okay. So maybe it should be only the paranoid thrive, because we all survive until we don't.
Right. And it was written by Andrew Grove, who was the CEO of Intel at the time. This is in the early 90s. And it's a great book. It's still a great business book. Now, regardless of what's going on with Intel today, he's no longer the CEO, obviously, but it's a great business book. And it's something that I think everybody should read. But it goes through basically how, especially for a tech company, and I think a lot of these principles still ring true, you have to shift, you have to change, you have to morph in order to stay relevant.
100%.
And you have to take a lot of risks to do that. I mean, people thought he was nuts for some of the decisions he made, but he made them, and Intel survived, if not thrived, afterwards because of what he did. And I think it also shows, if you go back to that period of time, it also shows what can happen to a company over a long period, over a life cycle, if things don't change fast enough, and how quickly you can become irrelevant
100%.
if something doesn't change.
No,
right? And
listen.
I'm not even saying that just about Intel. I think we have to keep this in mind as investors, especially in this AI theme. Don't decide today who the winner is going to be 10 years from now, because so much can change.
Amen, sister. It's interesting. Now, on a serious note,
Yes.
part of my problem is, like, I am always the half empty person, number one. And I was raised in Wall Street. What can go wrong will go wrong, which speaks to a certain level of paranoia. Like, I'm always, and that has not been the right way to view the world over the last couple of years, because it's gotten you nowhere outside of a handful of days. But to the earlier point, it doesn't mean that that's not the right way to continue to be, because once you get complacent, for example, IBM got very complacent and they went into obscurity for a period of time, subsequently made an acquisition and getting themselves out of it. To a certain extent, Intel is the poster child for that, because Intel was on the top of the shit pile. AMD only existed so Intel wouldn't be a monopoly, and then the world sort of passed them by. They became irrelevant really quickly. So you have to, almost by definition, you have to have a level of paranoia, regardless of where you are on the pecking order or in sort of the, what's the ecosystem, the feeding chart of things, right? Does that make sense?
Yep, it does.
You can be an orca, or you could be a tune, or you're like a little sardine.
There's a graphic in the book, and I don't have it up in front of me, but I'll just explain it real quick. It's basically every company hits what's called a critical inflection point. You have to make a decision, and that decision is different for each company. But whatever you choose, whatever you decide at that inflection point is what determines whether or not you will go up the arc and thrive, or you will just very quickly go down the arc and die out. So I think it's something to keep in mind as we go through, especially in 2025, as we listen to earnings, as we watch if this AI thing comes to fruition, if we can get profit out of it, if it starts to actually rubber hits the road and it starts to work for companies, those are the inflection points.
Do you think when there were horse and carriages, like in the early 1900s, for example, before cars, like, you probably didn't have the term when the rubber hits the road, because there was no rubber hitting the road.
Suppose. So what was it?
I don't know. I'm curious as to
when
like
the hooves hit the dirt.
You know, there was a period of time in New York where, you know, everybody traveled by horse and there were a lot of horses, and the amount of horse shit in the streets was a real problem.
Still in Central Park.
That's, you go back to like the early 1900s. I mean, that, well,
yeah,
but multiply that by like 1,000.
Yeah. Now we talk about bovine emissions as an issue.
Who's we? Well, you're in the Midwest.
The royal we.
Bovine emissions.
Yeah. You know what that is?
Yeah, it's cow farts.
Cow farts. Yeah.
Well, they got a fart too.
They do.
Everybody does. People pretend that they don't. Bullshit. No, I'm just telling you.
Well, I don't know what's the next animal that's bovine emission. What are we talking about in 20 years?
Who's to say? Who's to say?
Yeah.
Honest to God. Have you enjoyed this?
It's obvious Dan isn't here today because
nor's Amanda. Nor's Amanda. No, but listen, we covered a lot of stuff. We did what we needed to do,
including animals and
Ryan Braun,
bathrooms, and
Fred Joseph, the book.
This is
Lester Grove.
One of those unsupervised days, folks. I hope you enjoyed it.
We will be back on Tuesday because Monday is Martin Luther King Day. It's a market holiday. So back on Tuesday. Tomorrow, Friday, there will be an On the Tape podcast that drops. That will be Swizzle and Danny Moses just sitting down and chatting about things.
Love me some Danny Moses.
Do you really?
Yeah.
He's an interesting guy.
He's a great guy.
He can be sort of, you know, you can get under his skin. You can rattle him.
Yeah.
Like, I can't rattle you that, like, you've grown accustomed to me. Yeah, so, you know, I could just come at you with some weird shit, but you're like, you stay in the box. Like, you stay in the pocket. Like, I don't scare you anymore. I got to change my tactics.
I'd be so disappointed if I ever came out of the box. If I
no, I don't. I wouldn't.
Out of the batter,
I wouldn't respect you.
Yeah.
And your father wouldn't. I mean, think about it. Like, I didn't raise you to be like
to
chick.
Step out of the box.
Do you think? By the way, are we allowed to say anything here or no? No, you know what I'm saying. Have we announced anything on this show?
No, we haven't.
Am I allowed to do so?
Sure. Dan's going to be so mad he wasn't here for it.
Well, it's his problem. I mean, not only is Amanda pregnant now with her second child, but EYT is having a child in March. This is January.
Yep.
So that's February, March. So you're in the
Like
home stretch.
right around the corner.
You're in the third trimester. Like
I
you're
am.
like legit.
Yeah. Legit.
Now,
legit
I am
pregnant
not going
now.
to tell. I know, unfortunately, I know the sex of the baby because I don't like
You
knowing.
don't know.
And I don't want to
I
tell.
wanted to know like day 4.
What do you need to know?
I don't know.
There's so few
Names,
surprises in
all of
life.
it.
Why ruin like the
Oh, well,
like,
everything else about this kid will be a surprise. I don't
well,
know what he
hair
looks
color,
like,
eye
what he's gonna
color?
be like. Yeah,
You never know.
a lot of things.
But don't give away the okay.
Well, I already did.
You said did you use a pronoun?
I did use a
son of a bitch. But that's exciting news.
Yes, it's very exciting. I mean,
I was
I've known
so
for
hap-
31
no,
weeks, but
I was so elated when you told. Now,
yeah,
you know, there's sort of a calendar as to when you want to let the world know. And I don't know if you've let the SDs on the HTR
everybody
know.
knows. There's no hiding it after a certain point.
People can't tell now just looking at you.
That's true. Well,
Because,
anyway, yes, we are elated. We are over the moon.
as you should be.
Due dates in March.
It's going to be a lucky young man to have you as a mom. I mean that sincerely.
Thank you.
You are going to be the quintessential. It's going to be wonderful. And if you need a babysitter, like I got to tell you something, as Bill Hochman knows, little kids dig me and old people, like everything in between, I don't do well. But that like 8 and younger and 65 and older, kill it.
All right.
And I'm listen.
You're hired.
I had 3 kids. They're still around.
Yeah, you kept them alive.
So
I mean, that's kind of all you ask for sometimes, right?
That's it for today. I want to thank Jacob for pulling up that Ted Williams graphic. That was perfect. Actually, it suited the show pretty well. Thank you for the questions, everybody. Thank you, EYT of SoFi. Thank you, our audience, who's always with us. Bill Hochman, rocking a Yankee hat. Now, I said that because I don't use that expression ever. Rocking. Are you rocking that? It's like, that's really a douchey thing to say.
Well, you just did.
But I did it in sort of.
Okay.
And I want to thank Timmy back in HQ. Amanda's not feeling well, but she's here, and Jacob just killing it.
She gets better.
We'll see you folks next week. Bye.
Later.